Welcome to the deep dive. You know, if you're like most people listening, your online feed, your conversations, everything, it's
Mm.
just absolutely swamped with financial advice,
It
right?
totally is coming from all
Yeah,
directions.
you've got the uh the gurus promising you the moon with get rich quick schemes over here.
Mm-hmm.
And then on the other side, you've got the doom and gloom crowd saying the sky is falling, crash is coming tomorrow.
Sell everything. Hide.
Right. And you shared this really interesting set of sources with us, specifically focused on, well, the principles of sustainable wealth.
Mhm.
Because the goal here, for you listening, is to actually cut through all that noise, find what really works.
Find the core truths, yeah.
Our mission today, it isn't really about finding the next hot stock pick, is it?
No, not at all.
Yeah.
It's about something maybe less exciting on the surface, but way more important.
It's about distilling that almost brutal discipline, the mindset you need to actually build wealth steadily, consistently, no matter what the market's doing day to day.
Ex-
Because the big question is, why do so many people find investing so hard when, the basic rules are actually pretty simple?
They really are.
So today, we're going to try and separate that slow, quiet, successful path, the one resilient investors actually use, from all the loud, emotionally draining and frankly, often financially devastating stuff you see everywhere, the active speculation.
Mhm.
We'll look at those like non-negotiable rules for just keeping stable.
The foundation.
Yeah, the foundation. Then we'll analyze why active trading is, well, almost impossible odds for the average person. And then, maybe most importantly, we'll dig into the mindset, the actual systems that can pretty much guarantee progress over the long haul.
That's a perfect way to frame it. Look, this deep dive, it's really about psychology. It's about setting up a structure.
Okay.
If you walk away with just one thing today, it should be this. Based on everything we looked at in these sources, real financial success, it comes from building a system, a structure that shields you, insulates
Yeah.
you from your own panic.
Right. From those gut reactions when things get choppy.
Precisely. We are trying to move completely away from that anxiety, that drama of trying to time the market perfectly. Buy low, sell high, every single time.
Which is impossible.
Basically impossible. And instead, we're focusing entirely on, well, the admittedly kind of dull, but incredibly powerful force of just time in the market.
Yeah.
Being invested, staying invested.
Okay, great. So let's unpack that. Where do we start? We need that baseline, right? That defensive wall you mentioned.
Yeah, the thing that protects your capital before you even start thinking about growth.
The successful folks in these sources, they all started with the same, absolute must-haves. Rules that are completely defensive in nature. Let's call them the golden rules of stability. And you have to have these sorted before you even think about opening a brokerage account, before buying anything.
Absolutely critical.
Rule number 1, never, ever, under any circumstances, invest using debt. Period.
Yeah, no wiggle room on that one.
That means no credit cards for investing, no taking out personal loans, and definitely no margin trading where you borrow from the broker.
Right. The money you invest has to be yours, free and clear.
Why is that so fundamental?
Well, because debt brings in this external pressure, this timeline that isn't yours.
Ah, okay.
If you owe money, right, and the market suddenly tanks, which it does,
It always does eventually.
you might be forced to sell your investments at the worst possible time just to pay back that loan, pay the interest. It takes away your control. You lose the ability to wait it out.
Got it. And that ties into rule 2, right?
Directly. Never invest more money than you can actually afford to lose.
And how do the sources define afford to lose? Because that sounds a bit scary.
It does, but it's about realism.
Mhm.
It means money that if it completely vanished tomorrow, poof, gone. It wouldn't fundamentally change your life. You could still pay rent, buy groceries, keep the lights on. It wouldn't impact your immediate or even medium-term survival.
So not your emergency fund, not your down payment savings.
Absolutely not. This is separate capital specifically for long-term growth that carries inherent risk.
Okay. And the third rule. This one feels like the anchor people forget when they get excited about stocks.
Oh, definitely.
Yeah.
You absolutely must ensure your earned income is secure.
Meaning your job or your business.
Exactly. Whether it's a stable job, hopefully with good benefits, or if you're entrepreneurial, a solid business that generates consistent cash flow. You need that reliable stream of money coming in from your work.
Why is that so crucial for investing?
Because if you don't have that secure base, you're going to be tempted to panic sell. Massively tempted.
Right.
Imagine the market drops 20%, maybe 30%, which, again, happens every few years on average. If your job feels shaky and you know you might need that investment money to pay bills next month,
You're selling. No question. You're liking in the
you're
loss.
selling at the bottom. The whole discipline of passive long-term investing just collapses if you don't have that bedrock of secure income, allowing you to ignore the noise and just ride out the storm.
Yeah. So these three rules, no debt, only risk what you can afford to lose, secure income, that's the price of admission.
It really is. The sources stress this. The vast, vast, vast majority of people, maybe 90% plus, who just want to build wealth steadily over time, they must stick to these three principles before they even think about the next step.
Okay. So the defensive wall is up. What's next? You said it gets surprisingly simple after this.
It really does, because the next step kind of bypasses all that complicated stuff like trying to pick individual winning stocks.
Okay.
The main tool, the core of this defensive strategy, is the low-cost ETF or the low-cost index fund.
Right. ETFs, index funds, we hear those terms a lot. Can you break down what they actually are in simple terms?
Sure. Forget the jargon for a second. Think of it like this. It's just a basket holding lots of different stocks.
Okay, a basket of stocks.
Yeah, instead of buying just one company, you're buying a tiny piece of a whole group of companies, maybe 500 companies, like in an S&P 500 index fund.
And the benefit isn't just owning lots of things, it's about the risk, right?
Right.
Let's use that McDonald's example from the source material.
Perfect example. Let's say you absolutely love McDonald's.
Yeah.
You think it's the best company ever. So you put all your investment money, 100%, into McDonald's stock.
Okay. What's the potential upside?
Well, if McDonald's invents, I don't know, the McRib perpetual motion machine,
Right.
and the stock goes to the moon,
Yeah.
you make a killing. Maximum upside. Huge potential gains.
But what's the flip side? The worst case.
The flip side is concentration risk. It's catastrophic risk. What if, terrible management runs it into the ground, or there's a massive food safety scandal, or a competitor just completely eats their lunch, pardon the pun.
Right.
McDonald's stock could realistically go way down, even towards zero in an extreme scenario. And if that happens,
Your entire investment is wiped out, gone, panic stations.
exactly, total loss.
Yeah.
Now, contrast that with buying an S&P 500 index fund ETF.
Okay, so McDonald's is in that fund.
Right, it's one piece. But it's alongside, say, 499 other huge U.S. companies. Apple, Microsoft, Johnson & Johnson, all the big names.
So what happens if McDonald's in this scenario goes bankrupt?
If McDonald's fails catastrophically, well, it's definitely not good for the fund, but the impact on your total investment is tiny, almost negligible.
Because you still own pieces of the other 499 companies.
Exactly. They carry the load. The fund might dip a tiny bit, but it's not wiped out. You've diversified away that company-specific risk.
That's the power of diversification then. You're giving up that tiny chance of like 100x returns on one stock.
Which is incredibly rare anyway.
Right. In exchange for basically removing the risk of losing everything.
Precisely. The goal here isn't to hit a home run on one company. It's to capture the general upward trend of the whole economy, or a large part of it, over many, many years, decades really.
And you mentioned these funds are ideal for passive investors because of automation. It's not just diversified, it's like self-managing.
Exactly. Self-cleaning, almost. Yeah. Think about it. These funds are typically managed by computer algorithms following preset rules.
Okay.
So let's say a company in the index, maybe our troubled McDonald's example, starts failing. Its market value drops. It no longer meets the criteria to be in the S&P 500.
What happens?
The computer program automatically kicks it out of the index, out of the fund's basket, and it automatically replaces it with the next company on the list that does qualify. The fund stays healthy, reflecting the current top 500 companies, and you, the investor, didn't have to do a single thing.
No research, no panic selling the failing stock.
Zero. This structure basically eliminates the need for what's called fundamental analysis for the average person.
Which is?
That's the deep dive stuff. Spending hours, days, weeks reading company reports, earnings calls, analyzing balance sheets, trying to figure out if a company is undervalued or overvalued, tracking competitors, geopolitical risks.
That sounds like a full-time job.
It is a full-time job. That's what professional active investors do. If you're not willing or able to put in that level of work for every single stock you own,
Which most people aren't.
right, then you absolutely should not be picking individual companies. You use the ETF, the index fund, let the automation handle the diversification and the cleaning process. It mitigates the workload and, crucially, the risk.
Okay, that makes a lot of sense. Defensive rules, diversified funds. And that leads us to how you actually buy these things consistently. The core strategy, dollar cost averaging, DCA.
The DCA, the cornerstone of passive investing execution.
And the beauty of it, according to the sources, is its sheer mechanical simplicity. It takes the thinking out of it.
Completely. You pick your low-cost broad market ETF or index fund. Let's say then it's S&P 500 fund.
Okay.
Then you set up an automatic investment. A fixed dollar amount, say $50, $100, whatever fits your budget, gets pulled from your checking account and invested into that fund every single week or every payday. Every month, whatever the interval, it's automatic.
Like a bill payment, almost.
Exactly. Platforms like M1 Finance and many others now are designed specifically for this. Set it up once, link your bank account, and the money just flows automatically into the investment. Hands off.
And the psychological benefit here is huge, right? Because it stops you from trying to time things.
Immense psychological benefit. It completely neutralizes two big human failings in investing. FOMO, fear of missing out.
Right, chasing stocks when they're already high.
And panic selling, or just fear when things are low. Recency bias. DCA doesn't care about the headlines.
Just buys.
It just buys. The automatic purchase happens whether the market is soaring and everyone's euphoric or whether it's crashing and everyone's terrified. Emotion is removed.
So if the price of the ETF is high that week,
Your fixed dollar amount automatically buys fewer shares.
then if the market's down, the price is low.
Your same fixed dollar amount automatically buys more shares. You're essentially getting a discount without having to nervously click the buy button during a scary downturn.
And over time, years and years, this averages out your purchase price.
Exactly. It smooths out the bumps and ensures you're consistently participating in the market's general long-term upward drift, assuming history holds.
Yeah.
You set it, and then the hard part. You forget about it for like a decade or longer.
Okay, that's the core passive approach, but you mentioned there's a slightly more, let's say, engaged option. Still passive, but a bit opportunistic.
Yeah, a small caveat or maybe an enhancement for people who are comfortable. The default should absolutely be pure DCA, set and forget.
Wow.
But if you're already doing your regular DCA and you've done your homework and you have some extra cash set aside maybe from that 10% savings bucket we'll talk about later,
Okay.
you can pay a bit of attention to major market events.
Okay.
We're not talking about little 5% dips. We're talking about the big ones, the crashes. What's the source called Black Friday for assets?
Great. When everything is suddenly on sale, like 30–40% off because of widespread panic or a major crisis.
Exactly. In those rare moments, if you have the stomach for it and the prepared cash, you could choose to deploy a bit more capital than your usual DCA amount, buying more shares of your chosen ETF at that deeply discounted price.
So accelerating the buying during a crisis?
Yeah, but, and this is crucial, the caution remains. For the average person, this should still be done at the ETF level, the broad diversified fund.
Not trying to pick the individual stocks that might bounce back fastest.
Definitely not. Don't try to be a hero picking single stocks in a crash. Stick with the diversified basket even for your opportunistic buys. Keep it simple, keep it diversified.
Okay, so we've got the defensive wall, secure income, no debt, risk tolerance. We've got the tool, diversified low-cost ETFs, and the method, automated dollar-cost averaging, maybe with a little extra buying in crashes. That seems like a solid plan.
It's a robust, time-tested plan for building wealth slowly and steadily.
But what happens if you step outside that plan? What if you try to get rich quick? That takes us right into section 2, because the sources are pretty brutal about the odds when you leave that passive safety net. All right, let's really get into the harsh truth about active trading. The sources threw out this comparison that really made me stop and think.
Yeah, it's designed to be provocative.
Okay, so imagine you, the average person listening, you have $1,000 you're willing to risk. Just $1,000. The question was, are you better off taking that grand to a casino and playing blackjack, or trying to actively trade stocks with it?
And the answer, which probably sounds crazy to a lot of people, was
You're better off playing blackjack.
you're better off playing blackjack. Why? Because, statistically speaking, your odds of winning, or at least not losing everything immediately, are probably slightly better at the blackjack table than they are trying to day trade against professionals.
And even if you lose at blackjack,
At least you might get a free drink and have a bit of fun doing it. Whereas active trading, for most retail investors, is almost statistically guaranteed to lead to losses. Or, best case, you might match the market return, but with like 100 times more stress, fees, and effort than just buying the ETF.
okay, almost certain loss. Why are the odds so stacked against the little guy? It comes down to who you're competing against, right?
Absolutely. You're not just trading against other random people on their laptops. You are stepping into the ring with the heavyweight champions of the financial world. You're competing against institutions with resources that are just mind-boggling.
Like the example used, Ray Dalio's firm, Bridgewater. the biggest hedge fund on the planet.
Exactly. When you place a trade trying to exploit some perceived inefficiency, you are directly competing against them, and thousands like them.
Okay, let's talk about those resources. You mentioned they spend hundreds of millions a year just on research. I think the figure was $200 million. What does that actually buy them that I can't get with, a Bloomberg terminal subscription or some clever Google searches?
It buys them advantages on multiple levels. It's not just paying salaries for PhDs, though they have plenty of those. That $200 billion year after year buys things like,
Okay.
1, unbelievably sophisticated AI and machine learning models. We're talking systems developed over like 25 years. They can analyze thousands of data streams simultaneously, global economic indicators, weather patterns impacting agriculture, satellite imagery tracking oil tanker movements or factory output, even anonymized credit card spending data.
Wow. So they see economic shifts happening before the official news breaks.
Milliseconds before, sometimes longer. The AI translates all that into potential market movement before it becomes public knowledge. 2, they buy proprietary data feeds, information streams the public literally cannot access or that would cost an individual thousands, tens of thousands a month. They might know specific product sales trends weeks before company reports earnings.
Okay, AI, data. Yeah. What else?
3, physical infrastructure. This sounds crazy, but they invest huge sums in things like dedicated fiber optic cables, running directly from their offices straight to the stock exchange's computer servers.
Why? Just for faster internet.
It's about latency. Reducing the time delay for their orders to reach the exchange by microseconds, millionths of a second.
Microseconds. Does that tiny difference actually matter?
When you're trading millions or billions of dollars and competing against other algorithms trying to do the same thing, that microsecond advantage is the difference between getting your massive order filled at the price you wanted or missing it entirely as the price moves against you because someone else was faster.
Okay. So the conclusion here is pretty stark then.
It's incredibly sobering. The odds, the actual mathematical probability of a regular person sitting at home finding some genuinely undervalued stock or some market inefficiency that these institutions, with their AI, their data, their speed, and their thousands of analysts haven't already found and traded on. Those odds are basically zero.
So any edge you think you found?
It's already gone. It's been arbitraged away by the professionals hours, minutes, or even milliseconds before you saw it. You're playing their game, but you're playing it way, way too late.
Which is why it's so important to understand the difference between trading and investing. They sound similar, but the sources draw a very sharp line.
Very different beasts, different goals, different mindsets.
Trading, as defined here, is that short-term game, right? It's staring at charts all day.
Watching the candles.
Yeah, those stock chart things. Trying to predict the next tiny wiggle in price. It's highly emotional, lots of rapid buying and selling.
And, as the sources noted, it can be incredibly addicting. Like gambling. That dopamine hit from a quick win, the despair from a loss, it messes with your judgment.
Okay, so that's trading. What about active investing then? Is that different?
Active investing, in the sense used by, say, Warren Buffett, is still fundamentally long-term. And it should be non-emotional, though that's hard.
How does it work?
It means doing that really deep fundamental research we talked about earlier.
The full-time job stuff.
Yeah. To identify what you believe is a truly fantastic company or maybe a specific sector ETF that you understand inside and out. And then, here's the key. You wait. You wait patiently, sometimes for years, for the whole world to get scared, for the market to tank.
You buy during the crash.
You buy when there's metaphorical blood in the streets, when high-quality assets are available at a significant discount because everyone else is panicking. You buy that great company or ETF you researched when it's on sale, and then you hold it for years, decades, waiting for the inevitable recovery and long-term growth.
So it requires incredible patience, research, and emotional control. Still very different from day trading.
Worlds apart.
Yeah.
One is about long-term ownership based on value. The other is about short-term price speculation.
And it's telling that even people who really understand markets, like the host in the source material, often just choose the simple passive route anyway. He basically said, look, I'm probably too stupid to consistently beat the market.
Which is refreshingly honest.
So I'm putting my money in passive funds and focusing my time and energy on my business where I actually can generate a better return.
It reinforces that idea of choosing the right strategy for you.
Exactly. Playing to your strengths and acknowledging the near impossibility of beating the pros at their own game.
Okay, and this leads to a really important warning, especially with the rise of online communities and easy access to complex tools. we have to talk about the traps, the sensationalism, and the risk.
Yeah, this is critical. Platforms like Wall Street Bets were mentioned. While they can be entertaining, the kind of emotional hype generated there can lead people, especially newcomers, into making really devastating financial mistakes.
Chasing meme stocks, things like that.
That's part of it. But the bigger danger highlighted was the misuse of complex financial instruments, things beyond just buying stocks or ETFs.
You mean like options, calls and puts, futures.
Exactly, particularly instruments that carry a terrifying concept called unlimited downside.
Okay, unlimited downside. That sounds bad. What does it mean? Let's contrast it with regular stock buying. Right. When you buy, say, $1,000 worth of Apple stock or an S&P 500 ETF, what's the absolute worst thing that can happen financially?
Okay, the stock goes to zero, the fund goes bust, I lose my $1,000.
Exactly. You lose money you put in. Your risk is capped at your initial investment. The $1,000 is the maximum you can lose.
Okay, that's understandable risk.
Now, consider certain types of options trading, like selling naked calls or shorting stocks without owning them, or trading futures contracts. These can have unlimited downside,
Meaning, you can lose more than you invested.
potentially vastly more. You can end up owing your brokerage huge amounts of money, far beyond your initial deposit.
How? Can you give a simple example?
Okay, let's try a simplified short selling example. You think Tesla stock is overpriced at $100, so you borrow shares and sell them, hoping to buy them back cheaper later. Let's say you shorted $10,000 worth.
Yeah.
But suddenly, unexpected great news comes out or becomes a meme stock, and it rockets up to $1,000 per share.
Oh.
You are now obligated to buy back those shares you borrowed at the new price of $1,000 to close your position. Your initial bet was $10, but the cost to close could be $100. You could instantly owe your broker $90,000 you don't have.
Wow. And the source mentioned seeing people suddenly get margin calls for like $75,000 out of the blue.
Yes, because they clicked buttons, entered trades using instruments they didn't fully comprehend, maybe based on a hype they saw online, without understanding that the potential loss wasn't capped. It could theoretically be infinite if a shorted stock just kept going up.
So the message is crystal clear here.
Absolutely. For you, the average person listening whose goal is sustainable, quiet wealth building over time, trading, especially using complex instruments you don't understand 110%, just put it out the window. Don't touch it.
If you can't explain the absolute worst case scenario down to the last penny of potential debt, you shouldn't be using that tool.
Precisely. The path to wealth we're discussing is frankly boring. It's consistent, it's safe, it's not flashy, it's not risky like that.
Okay, so foundation is defense and passive funds. Active trading is basically a no-go zone. What's the next big hurdle then? It's not the market itself, you're saying.
Nope. The next major challenge, once your system is running, is dealing with the constant barrage from the media and, frankly, your own emotional brain, which seems designed to sabotage your disciplined plan.
Right, so you've got your automatic DCA going into your ETF. The system is working. But now your job becomes managing yourself, managing the noise.
Exactly. Your biggest active role now is filtering the flood of information that's specifically designed, often unintentionally, to make you feel either panic or greed. You have to learn to be, as the source put it, stone-cold logical.
And a big part of that noise comes from how financial content gets created and distributed online, right? There's a really interesting point about algorithms.
Yeah, this was a fascinating look behind the curtain.
Yeah.
The sources basically laid out this fundamental conflict between creating responsible financial education and what actually gets clicks online.
The algorithms don't reward calm, measured advice.
Not really. Content that promotes stability, patience, long-term thinking. It just doesn't perform as well, click-wise, as sensationalism. Fear sells. Greed sells.
The example used was pretty stark. Which headline gets more views? Headline A, market down 3% today, here's what long-term investors should know. Or headline B, crash imminent, sell everything now, be prepared.
Headline B wins. Every single time, by a huge margin. Like his algorithms, whether it's YouTube, news sites, social media, they're optimized for engagement, clicks, watch time, comments, and nothing grabs human attention and emotion like fear or the promise of instant riches.
So the calm, sensible advice might actually be less visible because it doesn't trigger those strong emotional reactions.
That's the structural problem. The content that might be best for your long-term financial health often gets buried by the content that's actually quite toxic to a disciplined portfolio.
And this puts creators, even the ones who genuinely want to help, in a tough spot.
It really does. The source mentioned this dilemma. Sometimes, to even get their sensible message seen, They feel they have to use a title that's maybe a little bit clickbaity, hint at some drama or urgency.
Just to get people in the door.
Exactly, to get you to click, so that inside the video or article, they can then deliver the actual calm, sober message about patience, DCA, ignoring the noise, seeing downturns as opportunities.
So the takeaway for us, the consumers of this content, is be skeptical of the packaging.
Absolutely. You have to learn to dissect the content once you click past the flashy title or thumbnail. Don't assume the headline reflects the nuance inside. Develop sophisticated media skepticism. Look for the substance, not the sizzle.
And is there a rule of thumb for filtering the general financial news flow? It always feels like extreme highs or extreme lows.
There's a great one that acts as a kind of mental filter, basically. When times seem really, really good and the media is euphoric, the reality is probably not quite that good. And when times seem really, really bad, the headlines are screaming, crisis, market crash.
Yeah.
The reality is probably not quite that bad either.
The truth is usually somewhere in the boring middle.
Almost always. Things are rarely as amazing or as catastrophic as the loudest voices claim. Your job is to use your own understanding, your own system, to stay grounded and filter out that hype. Because the hype is designed, intentionally or not, to make you do the wrong thing, buy high out of FOMO, or sell low out of panic.
And that constant emotional manipulation feeds right into what the sources identified as the real roadblock for most people. It's not about the tools.
No, the tools are mostly there now.
It's about the mindset.
Bingo. The prevailing assumption is often, I can't build wealth because I don't have the right tools.
Yeah.
I need a fancy broker, or I need access to secret information, or I need complex trading software.
Right.
But the sources argue, pretty convincingly, I think, that the real barrier for the vast majority isn't a lack of tool set. It's a lack of the right mindset. It's a failure of discipline and perspective.
Because the basic tools, cheap index funds, online brokers, automatic investing, they're accessible to almost anyone with internet and a bank account now, aren't they?
They really are. Democratized to an amazing degree.
So what is that mindset problem then? What does it look like?
It often looks like this belief. Investing isn't worthwhile unless I have a big chunk of money to start with. I need $10,000 or $50,000 or $100,000 before it makes sense, or I need a finance degree first.
So people dismiss starting small.
Exactly. They think, investing $20 a week or $50 a month, that's nothing. That won't make a difference. It's not worth the effort. I'll just wait.
Wait until
I get that big raise. Wait until I save up a lump sum. Wait until I know more. They're waiting for the perfect moment or the perfect
It's
amount.
not waiting. That's the killer.
That procrastination, that dismissal of small beginnings is the absolute killer of long-term wealth building because it paralyzes you. It stops you from engaging with the single most powerful weapon you have in your arsenal.
Which is time.
Time. The long runway for compounding to work its magic. And we saw that powerful personal story in the sources, right? The expert sharing how they grew up lower middle class, definitely not wealthy.
Yeah.
And they changed their whole financial trajectory. Not by finding some secret stock tip or timing the market perfectly, but by adopting the right set of ideas. Realizing that consistent small actions stacked up over decades is how real wealth is built for most people. It's about embracing that possibility, that the American dream in that sense is achievable through discipline, not luck.
So the mindset shift is embracing the long game, embracing the quiet, maybe boring consistency.
Exactly. Fully internalizing that it's a marathon, not a sprint.
Exactly.
And that leads us perfectly into the mathematical engine that drives it all. The power of compounding. Okay, so if the last section was about getting the external stuff out of the way of the bad advice, the hype this section is all about leaning into the single biggest advantage you, the individual investor, actually have. Math, specifically compounding.
Right. And to really hammer home why starting early, even small, is so critical, let's walk through that compounding example from the sources. It's pretty mind-blowing.
It really is. It should be motivating for literally everyone listening.
Yeah.
Okay, picture this. You're 21 years old today, just starting out.
Okay.
You make a commitment. You find just $100 a month. That's it. Less than $4 a day. Maybe you cut one fancy coffee, pack a lunch, whatever. You find $100.
And you invest it automatically.
Automatically using DCA into a simple, broad, low-cost index fund, like that S&P 500 fund we talked about.
Okay, $100 a month starting at 21. What happens?
If you just keep doing that consistently, automatically, every single month, until you retire, let's say around age 65 or 66, so about 44, 45 years.
Right.
And let's assume you get the historical average market return, which has been around 10% per year over the very long term. Some years up, some down, but averaging around
Wow,
10%.
okay. 44 years, 100-month, 10% average return. What's the result?
The result is
Yeah.
you retire a millionaire.
Wait, seriously? Just from $100 a month?
Just from $100 a month, you'd have over $1 million saved up.
That seems almost unbelievable. Let's break that down. That assumes you never increase the $100, right? Even if you got raises later.
Correct. This calculation assumes you stuck to only $100 a month for the entire 44 years. And think about how much you actually put in. $100 a month for 44 years is, what, about $52,800 of your own money?
So you put in just over 50K and it grew to over $1 million.
Yes. The market, through the power of compounding returns on your returns, did all the rest of the heavy lifting. Time plus consistent investment equals incredible growth.
Okay, now let's show the flip side. What happens if you wait? What's the cost of procrastination?
Huge cost. Let's run the exact same scenario. $100 a month, 10% average return. But instead of starting at 21, you wait. You procrastinate. You finally start at age 35.
So you waited 14 years to start the same $100 a month plan?
Just a 14-year delay. Doesn't sound catastrophic, maybe, but the impact on the final number is devastating.
How devastating.
By waiting those 14 years, you lose all that early compounding, the time when your money starts working for you. Instead of retiring with over $1 million, you end up with closer to maybe $300,000.
Wow. So waiting 14 years wiped out roughly 2/3 of the potential wealth.
Roughly. Even though the difference in your own contributions was only about $16,800 less, 100 months by 12 months by 14 years, that delay, those lost years of early compounding, cost you over $700,000 in potential future wealth in this example.
That really illustrates it. Time isn't just a factor, it's maybe the most important factor. That first decade of investing does so much work later on.
It's incredibly powerful. And that's why the sources emphasize that real sustainable wealth is usually built in silence.
What does built-in silence mean?
It means it's not flashy, it's not loud. It's those quiet, consistent, automatic contributions happening month after month, year after year, completely the opposite of the hype around meme stocks or crypto overnight millionaires, which is often fleeting anyway.
In the early years, it must feel really slow, though. Unsatisfying almost.
Oh, absolutely. That's the hardest part psychologically. You put in $100, you check your balance a year later, and maybe it's only grown to $105 or $110. It feels like, is this even working?
Yeah, you don't see the $1 million yet.
Not even close. But the magic is happening beneath the surface. That tiny snowball is starting to roll.
Ah, the snowball analogy. That was a great visual from the sources. Let's unpack that.
It perfectly captures the process. Think about starting a snowball at the top of a snowy hill.
Okay.
Start with just a small handful of snow. Packing it together is the hardest part.
Right.
It's small, it doesn't pick up much more snow easily.
Right, you have to roll it quite a bit just to get it slightly bigger. Lots of effort for little gain initially.
Exactly. That's like your first few years of investing small amounts. It feels slow, laborious. Because the snowball your invested capital is small, its surface area is small, it doesn't gather much new returns with each roll year.
But what happens as it gets bigger?
As that snowball gets bigger through your continued contributions, adding more snow, and the market returns, snow sticking to it, its surface area increases dramatically.
So now each time it rolls over.
Each roll, each year, it picks up way more new snow. It starts going faster and faster, bigger and bigger, seemingly with less proportional effort.
Because the returns are generating returns on themselves.
Precisely. Eventually, you reach point, critical mass, where the amount of new snow the snowball picks up just by rolling, the investment returns, is way bigger than the handfuls you're adding yourself, your contributions. The growth becomes exponential. The snowball is doing the work for you.
That's the dream. But the big obstacle is
human impatience. Nobody wants to do that slow, boring rolling for the first 10, 15, 20 years.
People want the Lamborghini tomorrow, not the $1 million in 40 years.
Exactly. They see this powerful, long-term vehicle, slow, steady investing in broad funds, and they try to use it for short-term thrills. They jump in and out, try to time it, get impatient when it doesn't double overnight. They use the right tool the wrong way, and often end up getting hurt.
Okay, so the system works if you let it work over time. But is there a way to make the snowball grow faster without resorting to risky trading?
Yes. There's one main lever you can pull, assuming the market returns are what they are. You need to add more snow yourself, increase your contributions.
Put more money into the system. which means earning more, right?
Earning more definitely helps, but just earning more isn't enough. You have to avoid the huge trap that snares almost everyone, the income expense trap.
Explain that. It sounds simple but hard.
It's maybe the simplest concept in personal finance, but the hardest one to actually execute discipline on. Here it is. When your income increases, do not automatically increase your expenses to match.
Ah, lifestyle inflation.
That's the one. Most people think, my problem is I don't earn enough. If I just got a big raise, I'd be set. I could save and invest so much.
Yeah, that sounds logical.
But what actually happens, for the vast majority of people, according to studies and just observation, they get the raise or the bonus or start a successful side hustle. And almost immediately, their spending rises to meet that new income level.
The slightly bigger apartment, the newer car, more expensive vacations, fancier restaurants.
Exactly. They upgrade their lifestyle, which feels good in the moment. But it completely neutralizes the financial benefit of the extra income. Their savings rate stays the same or sometimes even goes down. They're making more, but they're not getting any wealthier because they're spending it all.
So they're still living paycheck to paycheck, just a slightly fancier paycheck to paycheck.
Precisely. They never get ahead. They never significantly accelerate the snowball because lifestyle inflation eats every single raise.
So how do you fight that? It seems like such a natural human tendency.
You need a system. You need automation. You need discipline that's built in, that happens before you have a chance to spend the extra money. And that's where the sources introduce that beautifully simple framework, the 7-5-1-5-10 system.
Okay, 7-5-1-5-10. How does that work?
It's a rule for allocating every single dollar that comes in the door. And the beauty is, it works conceptually whether you earn $40,000 a year or $4 million a year. The percentages stay the same. It removes the emotion and the guesswork.
Okay, break it down. For every dollar earned.
75 cents. That's your absolute maximum for spending. Everything goes in here. Housing, food, transportation, insurance, utilities, clothes, fund money, everything. 75% is the ceiling.
Wow, that forces you to be intentional about spending. Even
Yeah.
if you get a raise, you can spend more, but only up to 75% of the new total.
Exactly. It puts a guardrail on lifestyle inflation automatically. Next, 15 cents. That's your minimum for investing.
Minimum 15% goes
Straight into your long-term investments, your DCA plan, your snowball fuel. This happens automatically off the top, before the 75% spending even occurs. Non-negotiable.
Okay, so 75 spend, 15 invest. That leaves 10 cents.
The final 10 cents, 10%, is your minimum for saving. This could be building your emergency fund, saving for short-term goals like a house down payment, or maybe building up that cash reserve for those Black Friday for assets opportunities we talked about.
Got it. So 75% max spend, 15% min invest, 10% min save. And this applies to every dollar earned.
Every dollar. By setting this up, maybe even automating the transfers to the 15% and 10% as soon as your paycheck hits, you guarantee progress. You ensure that raises actually translate into faster wealth building because the 15% investment slice automatically gets bigger in dollar terms, preventing lifestyle inflation from consuming it all.
You're forcing the discipline through the system.
You're automating discipline. You control the expenses within the 75%, you automate the passive investing with the 15%, you build buffers with the 10%, and you just let time and compounding do their thing. That's the path.
That really brings it all together. The defense, the passive tools, the mindset, and the discipline system for execution. Okay, I think that brings us towards the end of this deep dive.
Yeah, it covers the core principles for that sustainable approach.
Let's try and summarize the main takeaways then.
Okay, I'd say, first, build that defensive wall. Make sure your income is secure. Don't invest with debt. And only risk capital you can truly afford to lose. Foundational.
Right, step one.
Second, forget trying to pick stocks or time the market. Focus exclusively on low-cost, broad-based passive ETFs or index funds. Let diversification and automation work for you.
Keep it simple, keep it diversified.
Third, absolutely avoid active trading, especially with complex instruments. You just can't win consistently against the professionals and their resources. It's a losing game for most.
Steer clear of that temptation.
Fourth, manage your own psychology. Be deeply skeptical of media hype and clickbait. Cultivate that stone-cold logical mindset. Don't let fear or greed derail your long-term plan.
Filter the noise.
And finally, embrace the power of compounding and ruthless expense control. Use a system like 7-5-1-5-BEN to force consistent saving and investing, especially as your income grows. Prevent lifestyle inflation. Remember, time, not timing, is your greatest asset. Start now, even small.
That's a great summary. Build the wall, use passive funds, avoid trading, manage emotions, and automate discipline with something like 7515 Den.
That's the essence of it.
And just to leave everyone with one final thought, something really provocative that underscores just how counterintuitive this all is. Remember that anecdote from the Wall Street Journal study?
Oh yeah, the monkey. It's classic.
They ran this contest, right? Pitting professional Wall Street traders and analysts
You-
against literally a monkey throwing darts at a list of stocks printed on a wall.
Yep. Completely random selections made by a dart-throwing primate.
Yeah.
No research, no algorithms, no emotion, just random picks, held long-term.
And the result, over a significant period.
The monkey won. The randomly selected, passively held portfolio chosen by the monkey throwing darts actually outperformed the majority of the human professional stock pickers.
It's almost unbelievable, but it perfectly highlights the point, doesn't it? Trying to be clever, trying to outsmart the market, adding layers of complexity and emotional decision-making often leads to worse results than just owning the market passively and consistently over the long haul.
Keep it simple. Keep it consistent. Let time do the work. The monkey knew best, apparently.
A humbling thought to end on. Don't forget to subscribe, and thanks for watching.